In 1992, the Indian stock market experienced the biggest financial earthquake in its modern history. Inside Bombay's bustling Dalal Street, an unprecedented wave of speculative fever was rewriting the rules of wealth and power. At the very eye of this storm stood a charismatic, relentless broker, Harshad Shantilal Mehta. From humble origins as a jobber in the BSE trading ring, he rose to become the undisputed kingpin, famously crowned as the Big Bull. Operating out of his firm, Crore Research and Asset Management, Mehta built a sprawling intelligence network. Hundreds of brokers, institutional contacts, and phone operators coordinated massive liquidity injections into select equities. In 1991, facing a severe balance of payments crisis, India dismantled the license Raj and opened its economy. A massive wave of optimism swept across Dalal Street, creating the perfect psychological backdrop for an unprecedented speculative boom. Trading inside the historic Bombay Stock Exchange was raw, chaotic, and entirely manual. Thousands of jobbers shouted bids in a crowded open outcry ring, where hand signals and paper soda books dictated fortunes in seconds. To understand the scam, one must look at ready forward deals, short-term repurchase agreements where banks traded government securities to meet statutory liquidity ratios. Mehta positioned himself as the indispensable intermediary. Because physical government bonds took weeks to deliver through the Public Debt Office, banks used a substitute document called a bank receipt, or BR. This paper receipt promised that bonds were held in custody. Mehta noticed a critical vulnerability. During the two-week settlement window between bank transactions, massive funds sat idle in his accounts. He realized he could deploy this short-term treasury cash directly into the booming stock market. When large institutions ran out of real securities to trade, Mehta recruited small cooperative banks like the Bank of Crore and Metropolitan Cooperative Bank to issue bank receipts on demand, backed by absolutely no real government bonds. With fraudulent BRs circulating freely, Mehta could obtain unlimited checks from top commercial banks. The banks believed they were buying risk-free sovereign debt, while in reality, they were holding worthless paper IOUs. Over 4,000 crore rupees, equivalent to billions of dollars today, were siphoned from the banking system and channeled directly into the Bombay Stock Exchange, creating an artificial, steroid-fueled bull run. Foreign banks like ANZ Grindlays and Standard Chartered were eager participants. Seeking aggressive quarterly profits, their local treasury desks bypassed standard verification, routing checks straight through Mehta's personal accounts. To justify skyrocketing share prices to analysts and the media, Mehta popularized the replacement cost theory. He argued that existing cement or steel companies were vastly undervalued compared to the cost of building new factories from scratch. Mehta did not buy the entire market. He aggressively targeted stocks with low public float. By continuously absorbing all available shares, he triggered historic short squeezes, forcing bearish brokers to cover at astronomical losses. The most legendary example was Associated Cement Companies, or ACC. In November 1991, ACC traded at just 200 rupees. By April 1992, relentless buying propelled it to an unbelievable 9,000 rupees per share. ACC was not alone. Across Dalal Street, stocks like Sterlite, Apollo Tyres, BPL, and Mazago Dock experienced parabolic vertical ascents. Every stock associated with Harshad Mehta became an instant gold mine. Ordinary citizens, from school teachers to retired pensioners, withdrew their lifelong fixed deposits to buy shares. For the first time in Indian history, the stock market became the primary dinner-table conversation across the nation. Mehta lived in lavish splendor, embodying the newfound wealth of a liberalizing India. He purchased a 15,000 square foot sea-facing penthouse in Worli, featuring miniature golf courses and a fleet of imported luxury vehicles, including India's first Lexus LS 400. Leading national magazines splashed his portrait across front covers, hailing him as the Pied Piper of Indian capitalism and the Amitabh Bachchan of the stock market. His press conferences drew larger crowds than Bollywood movie premieres. By early April 1992, the BSE Sensex crossed the astronomical 4,400 mark. The entire country believed the bull run was permanent. But underneath the glittering numbers, the entire edifice was resting on a mountain of forged paper and unbacked credit. Behind the scenes, investigative journalist Sucheta Dalal at the Times of India began noticing disturbing anomalies. She questioned how a single broker could mobilize thousands of crores in cash every trading session without massive institutional backing. On the morning of 23 April 1992, the Times of India published a bombshell front-page report. It revealed a staggering 500 crore hole in the State Bank of India's investment division and linked the missing funds directly to Harshad Mehta. Inside SBI's Bombay headquarters, top executives panicked. They demanded Mehta immediately return the securities or repay 500 crore rupees in cash. Mehta scrambled, attempting to repay SBI by borrowing even more from other institutions. Within days, every bank in India stopped accepting bank receipts. The liquidity pipeline that had fueled the stock market evaporated overnight. Without fresh billions flowing into Dalal Street, the artificial buying pressure completely collapsed. Dalal Street plunged into an catastrophic crash. Panic-stricken brokers dumped shares at any price, but with zero buyers in the ring, stock prices went into free fall. The BSE Sensex lost over 40% of its value in just a few weeks. As broker defaults mounted and brokers staged strikes, the Bombay Stock Exchange was forced to suspend trading for weeks. Millions of retail investors watched their life savings evaporate, leaving a trail of financial devastation across India. On 4th June 1992, the Central Bureau of Investigation launched nationwide raids. Teams of CBI officers raided dozens of brokerage offices, bank vaults, and Mehta's Worli residence, seizing truckloads of ledgers, check stubs, and forged documents. Harshad Mehta and his brother Ashwin were arrested by the CBI under charges of criminal conspiracy, forgery, and cheating. The big bull who once commanded the entire Indian economy was now an inmate in Mumbai's Arthur Road jail. India's parliament constituted a high-powered joint parliamentary committee headed by Ram Nivas Mirdha. For over a year, the JPC grilled cabinet ministers, Reserve Bank governors, and top bankers, revealing systemic corruption throughout the financial system. In June 1993, Mehta dropped another political bombshell during a packed press conference alongside lawyer Ram Jethmalani, claiming he had personally delivered a suitcase containing 1 crore rupees in cash to Prime Minister P.V. Narasimha Rao. The government vehemently denied the allegation. On the night of 31st December 2001, while under judicial custody in Thane jail, Harshad Mehta suffered severe chest pain. He was rushed to Thane Civil Hospital, where he died of a heart attack at just 47 years old, leaving dozens of legal cases unresolved. The 1992 scam catalyzed a complete revolution in Indian governance. The Securities and Exchange Board of India was granted sweeping statutory powers under the SEBI Act of 1992, establishing strict market surveillance and investor protection. To dismantle the broker cartels of the physical BSE ring, the government created the National Stock Exchange in 1994 with transparent, satellite-linked screen-based trading. Physical paper shares were replaced forever by electronic demat accounts. The 1992 scam remains the definitive turning point in Indian economic history. It proved that without transparency and strict regulation, financial innovation can devolve into systemic catastrophe. The story of Harshad Mehta stands as a timeless lesson on risk, greed, and the pursuit of market glory.